Hey everyone, it's PJ Patterson here from Market Update. Today's Friday, March 25th. It's about 6:30, and thought I'd just do a quick market update for everyone. There's not a lot going on, but I do want to hit on three key and big macroeconomic things that we look at, which are growth, inflation, and interest rates. Just so happens to be those three things are the three key drivers of the global macro policy. That's where we start with those three things. First of all, with growth, I wanted to show you a table here, if I can just grab it. Oh, there we go. And this is if I get it up here on the screen, this is the US GDP year-over-year projections. And I've been talking about this recently with growth slowing. Well, really what I'm talking about is GDP slowing. And quite clearly from this, the projections are for lower GDP numbers. Now, this is an important thing to note because the Fed is raising interest rates into a slowdown. The last couple of times they did this, you know what happened? The market crashed and they ended up reversing their interest rate hikes by ending up either cutting interest rates or implementing QE programs, that sort of thing. So this is a very interesting setup to note because we do have growth slowing and we do have the Fed raising interest rates. Now, to quickly pivot across to the interest rate conversation, let me go to this chart here. So the Fed's the market is predicting that the Fed is going to we're going to have seven and a half, in fact, rate hikes by by April or so of not April, excuse me, December of 2022. And so would be a huge deal. That would imply a cash rate, overnight cash rate of something like 2.2%, 2.25%, which is a huge cash rate. Now, the bond market's already been pricing in rate rises. That's why we've seen the 10-year, the 30-year, and other commensurate rates, the 7-year, the 5-year, et cetera, rising. And right now we have a 10-year yield sitting around somewhere around the 2.3% mark, up from, let's call it 0.2, 0.3% back in the middle of 2021. Massive, massive increase in interest rates. That was the market over the last 6 quarters, understanding that we had inflation in the market and pricing in rate rises. So I often say this, that the bond market sets interest rate policy, not the Fed. So the bond market's already moved. It's already moved, excuse me, it's already moved rates up to 2.32%. It's already done a bunch of the heavy lifting for the Fed. Now the Fed's just got to play catch up. But of course, what happens often with the Fed is it does the right thing at the wrong time. And what they should have been doing, as growth was accelerating and inflation was accelerating over the last 6 quarters, was they should have been raising interest rates, but they didn't do it. They had a great opportunity to do it. They could have just slowly done it as the economy was improving and recovering from COVID and inflation was beginning to ramp higher. They could have done that. Now, just quickly to go back to this table to have a quick look at CPI. So as you can see here, this is the Consumer Price Index. As you can see here, through 20, it was pretty benign. It had dropped off a cliff when COVID first sort of hit, and then it slowly started to ramp up, and then whammo, it just went from 2% to basically 7% in about 3 quarters. That's a massive rate of change higher, massive rate of change higher. And what we see now is inflation has probably peaked and is starting to moderate. And I think this quarter we'll have seen that peak. I think in large part that's going to be a function of what continues to happen with the energy complex, because of course energy is such a huge input into the inflation number. If we continue to see hostilities in the Ukraine, and God forbid if things expand to Europe or engulf the rest of the region, then all bets are off, and we'll have to evaluate it then. But at this stage, anyway, it's looking like inflation has probably peaked and is beginning to moderate. One of the things that I think I had it open. Yep, there we go. One of the things that suggests this to us is what's happening with the CRB index. So I know there's a lot of busyness on this chart here, but this black line here over to the left is the CRB level, and as you can see, if you can see it on here, this black line here, basically where this big red circle is showing that the CRB, in fact all commodities, oil and copper on here have kind of rolled over from these peak levels back in early March. So was early March the peak in the commodity cycle, this part of the commodity cycle? Could be. We won't know until we have a bit more time and space on that. But if you look at this chart, it kind of looks like that might be the case. Again, we need more time and space to see, but the market's certainly acting like we could have just seen the peak in those things. Now, if we have that corroborates or is a corroborating factor, I suppose, in the argument that I'm making that inflation, I don't know what happened to that chart where it went. Maybe it's, oh, there we go. That inflation, got too many things open, is going to begin to moderate. So this is important because, again, the Fed often makes massive policy mistakes. They do the right thing at the wrong time. And I think that's actually exactly what is happening right now, is the Fed is doing the right thing, raising interest rates at the wrong time. So just finally to lock off on the interest rate conversation, where did it go? We had, we have this chart here of the U.S. 10-year. This was the peak of the 10-year back in October of 19 at around 3-something percent, 3.1, 3.2%. Will we get back to that level? I doubt it. I think rates are in the process right now of peaking. And again, we just need a bit more time and space between now and I'd say another maybe month to 6 weeks to see what the market's actually going to do. We've got another Fed meeting in mid-April. Very likely that they'll raise interest rates there, but we'll have more data on U.S. GDP and other things coming through to suggest, what the likely direction should be in terms of policy from the Fed. Now, let's just have a quick chat about a few of the things we often talk about. Volatility, let's start with that. So the VIX, it's come down quite a bit. So we had elevated levels of VIX. It was rising and it was trending higher up until, about early March. And then we've had a nice pullback in VIX, but it's still in the chop bucket. And the risk range on VIX has widened massively, and that's often a concern because it just is often a precursor that we are going to see that this is not a consolidation, that we're going to see a resumption in the uptrend in volatility. So it's just something to keep an eye on, to be mindful that we are in the chop bucket, and we could easily re-enter that non or uninvestable bucket of vol. A couple of other indexes like the VIX for the NASDAQ has pulled back as well, which is good. Oil volatility hasn't really pulled back a lot. It has pulled back some. We did get a lot of vol, obviously, around the whole breakout of the Ukraine war, pulled back a bit, but we're still elevated there. Anyway, it's just worth noting the volatility. The final thing I'll just hit on today, this will be a short update because there isn't a heap of stuff going on that needs to be discussed. We've got, let me get the implied vol up. There we go. We have a lot of implied volatility discounts across the equity space and in some of the mega cap tech stocks here. And this is usually a sign that there's potential issues in the market. This is not a spot where I would be buying tech, even though a lot of these names, Amazon, Apple, Google, Microsoft, Facebook, Tesla, all the big mega caps, they had sold off. They've bounced a little bit here. The implied vol discount means that the market is complacent. And that's not a good thing to be right now, where I truly think we are in a bear market here, and we're having a bear market bounce. So again, not a time to be loading up on all your favorite growth stocks because frankly, we're not going to have growth in earnings. We're not going to have GDP growth. So a bad spot here to be buying that sort of stuff. In fact, if anything, you'd want to use this strength in the market to be probably selling down. So as an example, here's a chart of Apple. It's kind of gone straight up from a previous level around, again, that early March period. And, we'll see if it gets back above some of its previous highs. Probably not. This could very well be an intermediate top in Apple. And anyway, other charts would look very similar. That's probably about it for today. Pretty short update. And there isn't too much else to say except we need just more time and space here. The Fed needs to continue with their policy action. I'll continue to keep an eye on the bond market and rates to see if they go any higher. Again, I think they've probably peaked here, or they're in the process of peaking. U.S. dollar has had a little bit of a sell-off, but will continue to be strong. It's a quad 4 asset exposure, U.S. dollar, and other than that, watching the Australian market closely, because we could very well be going into quad 1 here in Australia. So if that's the case, then I'll be reloading on some Aussie equities and getting some exposures there, deploying some cash. But for now, I'm kind of sitting tight, pretty happy with the positioning, waiting to see what happens with the bond market. Loaded back up on some gold, looking for another buying opportunity there or a pullback rather, to buy some gold and silver, and maybe some mining stocks as well, and to allocate some capital there. But pretty much staying defensive at this stage, and that's the call at the moment, to remain in a defensive posture because of that quad 4 environment in the largest economy in the world, and now in Europe as well. So anyway, everyone, have a fantastic weekend. Stay safe wherever you are, and enjoy your weekend. And I'll come back with more next week. Take care.